Hello friends, good morning to all of you, and this is the video related to the RBWM JAIIB, and it is then it's related to maintenance of balance and the interest payment. Maintenance of the balance and the interest payment. So banks basically do require sometimes that the minimum average balance is to be maintained. That we say to be MAV. What is MAV? It is minimum average balance, minimum average monthly balance. That is MAV. It is required. And if it is not required, then the penalty charges may be applicable. And what is the calculation formula? It's very easy. It's very easy. So you have to basically look into the balance and further multiplied by the days, multiplied by the rate, and for the summation of all these two for the complete month and divided by the 365. This is the formula related to it for the interest calculation. For the interest calculation, this is the formula, right? So let's just assume that you deposited by cash rupees 10,000. Now the balance is rupees 10,000 here. And further, you again credited rupees 1 lakh to it. So the balance is now 1 lakh and 10,000. And further, you withdrew on another date rupees 20,000. The balance is 90,000. Then you basically withdrew 2,000, 88,000, and so on. So these transactions were done. So these transactions were done. And now let's say case that we have to calculate the interest for this particular month of April 2021. And the rate of interest we assume to be 3% per annum over here, right? How will be calculating? Like for the balances, we have to calculate the rate of interest. So balance is like 10,000 is basically rupees 10,000 for 3 days. The balance is 10,000 for 3 days. So it will be 30,000. And basically then 1,10,000 for 2 days, it is 2,20,000, 90,000 for 1 day, 88,000 for 13 days, and so on. So we calculated the product over here. So we calculated the product over here. Product of what? Product of the balances and for the days that this balance remained there in the account. And that came out to be 24,79,000. Right? I'm not just going into the calculations right now, just explaining the things to you, right? So we calculated the product of the balance and the number of days the balance was there in the account, and we basically calculated the product of the same, and we summed all that, we basically aggregated all them all. Then it came out to be 24,79,000, and we basically calculated the 3% of it. And further, for 1 day, it will be like 203.75. So interest which was calculated was 203.75. Accordingly, we calculated. And the monthly average balance was what? It is 2,479,000. Whatever the product was there, total product was there, divided by 30. That is the average balance that is being maintained for this particular transactions. For these particular transactions, this balance was maintained. Clear with it? Getting the idea that how the balance is calculated, how the interest is calculated. So we just look at the balance. We just look into the balance, and then we look into the balance that for how many days this balance was there, like the number of days. Then we take the product of these balance into the number of days, and that was basically related to it. Okay. Now after that, it's about the time deposits. It's about the time deposit. Now what is time deposit? Like in the case of the demand deposit, you can be withdrawing it anytime, but the time deposit is there for the fixed period. It is there for the fixed period, and the fixed interest will be paid upon it. Fixed interest will be paid upon it, right? And as compared to that of the saving account interest, the interest which is paid is relatively higher side. It is on the relatively higher side. So what is the periodicity of the time deposit? The minimum it is 7 days, and for maximum it is 10 years. For maximum it is 10 years. And definitely the banks do make the efforts. They do prefer that the deposits are there in the multiple of 3 months, like 15 months, 18 months, 21 months. But it is not like mandatory. It's just a preference to the banks, toward the banks. Okay, so the minimum period for the FDR, for the term deposit, for the recurring deposit, it is 7 days. For the fixed deposit, I'm talking about particularly, it is 7 days, and the maximum period is 120 months, that is 10 years. Clear with it? Now let's have a look at the operational instructions. Like definitely it can be singly operated, it can be jointly operated, it can be either a survivor, it can be former survivor, right? It could be anything. In case of singly operated, like it will be operable by a single person only, and the nomination facility is also available there. When we're talking about the payable jointly, it means two joint account holders are there and they do provide their consent, and only then the transaction can take place, otherwise not. Like let's say even if the premature withdrawal is to be done, both have to sign, right? And in case of either survivor, after the maturity or on the maturity, anyone can operate the account. But if premature withdrawal is to be done, kindly please take a note. For premature withdrawal, all the account holders are to sign. The joint consent is to be given, right? But if anyone dies, if there is demise of one person, right, out of the either survivor accounts, then the survivor can be operating the account. Then survivor can be operating the account without any issues. And what about the former or survivor case? What about the former or survivor case? Only former, that means only the primary account holder. Former means we are talking about the primary account holder. Only the primary account holder can operate during the lifetime, and survivor will be getting the right only when the former dies. Only when the former dies, the survivor can be having the right, otherwise not. And what about the premature withdrawal? The former can be doing the transactions. The former can be doing the transactions. Clear with it? And what about the former survivors jointly or last survivor? Formers, survivors jointly, or last survivor. After the death of the former, all survivor must operate jointly. After the death of the former only, like where the case related to former is there, like let's say one former and multiple survivors are there. Multiple survivors are there, and that too jointly operated. Now, if the former dies, then the survivors will be operating jointly. That's the scenario. Getting it? Right? Further, after that, it's about the interest on the fixed deposits. Interest on the fixed deposit. So interest is generally paid on quarterly interval, but the banks can also be like in today's scenario, the banks are there are also the schemes where the banks are paying monthly interest to the customers. So it can be paid monthly, it can be paid quarterly, and it can be the case in case of, let's say, when it's a simple FDR. When it's a simple FDR, the interest will be credited. The interest will be credited to the saving account, right? But if it is a cumulative FDR or compound interest FDR, in that scenario, whatsoever the interest is, let's say if you have earned, let's say you have made an FDR of amount rupees 1 lakh, and you earned an interest of rupees, let's say 1000. So whatsoever the interest you earned will be accumulated in this FDR. Like it will then become 1 lakh 1000, and for the next quarter or for the next month, you'll be earning the interest upon 1 lakh 1000. So it is compound interest effect is there. So the interest is reinvested in case of the cumulative FDR. The interest is reinvested in case of the cumulative FDR. Clear with it? Then it's related to the term deposit accounts of the minor. Term deposit accounts of the minor. So the rules and regulations are all the same. The rules and regulations are all the same in case of the term deposit accounts of the minor. There are no issues related to it. Minors are allowed so as to open the term deposit account. Yes, they are basically allowed. Like if the self-operated account is also there, then also they are allowed. So if it is allowed by the banks, the customer is allowed, the minor is allowed, that they can be opening the fixed deposit account, right? And the same terms and conditions will be applicable here. After that, it's about the mode of repayment of time deposit. Mode of repayment of time deposit. From the exam point of view, this is important one. From the exam point of view, why? The threshold limit is 20,000. In general, we do not do the cash payment for the time deposit, but from the exam point of view, it's important. Let's say for if the amount is basically, let's say if the total amount, if the total amount we say that is principal and interest, whatsoever is earned, if it is greater than 20,000, then account pay payment can be made. Account pay payment can be made. So that's basically the case which is we should be there. We should be there, right? Otherwise, if it is, let's say, 1,999, right? In that scenario, it can be paid in cash also. But if it is 20,000, above 20,000, if it is above 20,000, then only the account pay payment is required, or through the customer account, the payment can be credited, right? Further, it's related to payment of interest, payment of interest on non-business working day. Let's say if the maturity date of the FDR is falling on some public holiday or bank holiday, that's a non-working day. Let's say maturity is on 31st of July and that's a holiday on that particular day. And your maturity of the FDR is on that particular day. Then the interest is to be paid on the original contracted rate. Let's say the interest was paid on the FDR 7%. So for this particular day also, for the holiday, when the maturity was there, because the no interest was to be paid otherwise on the maturity date, right? But now if there is holiday, the interest will be paid at the contracted rate. Clear with it? If the public holiday is there or non-working day is there, if the bank holiday is there. So whatsoever the intervening days will be there, the interest at the original contracted rate will be paid. After that, it's about the deduction of the TDS. The next topic, again, it's important one. It's about the deduction of the TDS. TDS is what? This is tax deducted at source. It is a tax deducted at source. Nowadays, tax deducted at source. Let's say if you have earned the interest on the FDR up to a specific threshold, it is allowed that no particular TDS will be deducted. No particular TDS will be deducted up to a particular threshold, right? But if it crosses a threshold, like for senior citizens who are aged 60 years or more, if the amount is greater than, if the interest earned is greater than 50,000 rupees, then the TDS is deducted. And also for others, if the interest earned is, let's say, greater than 40,000 rupees, then the interest is deducted. Then the TDS is deducted. And that TDS is deducted as per the section 194A of the Income Tax Act. You need to memorize this section. This is 194A. This is 194A. And further, if this is basically the tax rate. Otherwise, if the PAN card is available, the TDS is deducted at 10%. If the PAN card is available, the TDS is deducted at 10%. But if PAN card is not available, in that scenario, the TDS which will be deducted will be 20%. Then it will be 20%. Further, if you feel like that you're having income, total income is below the taxable limit. Let's say the person A is here, whose total income from all other sources is, let's say, total income, including the interest, is 3 lakh rupees per financial year. The person A knows that as per the applicable tax slab, that's not coming into the taxable slab. That's basically coming under the tax-free slab, right? Now, the person A, if the person A is aged below 60, he or she can be submitting 15G form. But if the person A is aged 60 or above, then they are to submit the 15H form. So it's just like telling the bank that we are not under the taxable limit and our total income is below the taxable limit, and hence the TDS should not be deducted from our interest earned, even if it crosses the threshold. The threshold is 40,000, exceeding to 40,000 for the persons who are not senior citizens. And if the person is senior citizen, then the threshold is 50,000. Clear? So they can be submitting the 15G form. 15G form is for the persons who are not senior citizens, and 15H form is basically for those who are senior citizens. In that particular scenario, the 15H form will be applicable, and this is to be submitted for each and every financial year. It's not the case that you have submitted the 15G form or 15H form in 1 year, then it will be applicable for the other year. So no, you have to submit it on each and every financial year, and it's valid for one financial year only. And further, it is to be submitted at the beginning of the each financial year. It is to be submitted at the beginning of the each financial year. Clear? And also whatsoever the TDS that will be deducted by the banks under the section 194A, under the section 194A, whatsoever the TDS is deducted, that is to be deposited, that is to be deposited to the government, that is to be deposited to the government by the 7th of the next month. Let's say if the TDS was deducted for the month of April, it is to be deposited to the government by the 7th of May. Then it's related to advances against the bank's own time deposit receipt. Now see, advance can be given, but only against your own time deposit receipt, but not related to other bank receipts. And what is the quantum that can be financed? It is 80 to 90%. It is 80 to 90%. Means, let's say if your FDR is 1 lakh rupees, you can take a demand loan amounting rupees 90,000 against it. Right? And the margin basically varies from bank to bank. And what is the interest rate charged? Like, let's say if the bank is paying you 7% on the FDR, the bank may be charging, let's say, the spread of 1 to 2% above it. That varies from bank to bank, right? The bank may be charging the spread of 1 to 2%, and that basically varies from bank to bank. And each and every FDR is basically considered as a separate contract. It is considered as a separate contract, and the receipt is known as what? It is known as a FDR, that is fixed deposit receipt, and that is to be surrendered. That is to be surrendered to the bank, because in case if the proper margin is not maintained, that the customer is not servicing the interest, or let's say the FDR matures, and in that scenario, what will be done? In that scenario, the bank will be like diluting the FDR and further will be servicing the debt. And there is a restriction from the Reserve Bank of India, as I told you, that no loan is basically allowed against the FDR of the other banks. This is very much important. You cannot be sanctioning loan against the FDR of the other banks. Then it's related to the renewal of the FDR. Renewal of the FDR. Like, customer instruction is to be given on or before the maturity. Renewal instruction on or before the maturity is to be given, and there is a instruction, let's say if it's related to the auto renewal facility, auto renewal instruction is given. So for the same tenure, the FD will be renewed at the prevailing rate of interest that will be applicable at the time of the maturity. Getting it? But let's say if no instruction is given for the 14 days, if it is not auto renewal and no instruction is given for the 14 days, then in that scenario, the renewal won't be done at the prevailing rate of interest. The renewal won't be done at the prevailing rate of interest. And there is one more factor. Let's say the FDR matured on 1st of the Feb, and there was no instruction given by the customer for the next 14 days. Let's say up to 14th of the Feb, no instructions was given by the customer, and customer said that I want to renew my FDR. No, the FDR will be renewed from 15th Feb onward only. But if the instructions were given on, let's say, 14th of the Feb even, then the FDR could have been renewed from the back date, from the 1st Feb itself. Getting it? Then it is related to the two-in-one account. Two-in-one account means saving plus FD account we are talking about. So two-in-one account means saving account plus FD linked account. That's said to be two-in-one account. So it's a combination of two things, current account or saving account plus the fixed deposit account. So you will be having the benefit of the two, like you will be having the liquidity. You'll be having the liquidity benefit that you wanted have always in the case of the saving account of the or the current account. At the same time, you'll be having the higher return also that you want to get in case of the FDR account. So you'll be having the higher returns and you'll be having the liquidity. You'll be having both the benefits at the same time, right? So the one case it's related to the auto sweep facility. Auto sweep facility. What is the working mechanism? So it's like a threshold amount will be there. It will be like a stipulated amount. It will be like a threshold amount which will be stated. Let's say if it is 10,000 rupees. So whatsoever the balance which is exceeding 10,000 rupees, that will automatically be converted to the fixed deposit. So that's about the stipulated amount, whatsoever the amount that you have stipulated. It may be 50,000, it may be rupees 1 lakh. That depends upon as that will be as per your wish from the customer's will. It will be right. So what will be the feature? Like as per the bank specific units or generally as in the multiple of the 1,000, it will be converted into the FDR. It will be transferred to the FDR. So let's say if you are having, if I have to set the threshold amount of rupees 10,000 and your balance is 15,000. So what will be done? So the balance above rupees 10,000, that is 5,000 rupees, will be converted into FD into the multiples of 1,000 each. So 1,000 into 5 FDRs will be created. So now you'll be earning higher interest rate as of the FDR, and also at the same time you will be having the liquidity with you. So let's say even if you want to withdraw 15,000 rupees, all those FDRs will be cancelled and the bank will be paying you 15,000 rupees. Clear with it? So that's the auto sweep facility. And the same way we are having another facility, that's a reverse sweep facility. Reverse sweep facility. Like I explained the mechanism to you already, that you are having 5 into 1,000 FDR, 5 into rupees 1,000 FDR. Now, if you want to withdraw the amount, so these will be cancelled and the amount will be paid to you. That's a reverse sweep facility. Why this facility is there? Because we want to honor the transactions without the failure. So there is no need to break the entire FDR. Let's say if you want to withdraw 11,000 rupees. So what will be done? 10,000 as such is already available in your account, and the 1,000 like one FDR will be cancelled and the amount will be paid to you, right? So it works in that way. So that's the reverse sweep. Play with it, and that will be all about this video. Thank you so much and see you again in the next video. If you want to get the complete course of JAIIB, the course is available in English only language also, and also the bilingual course is available. Simply just do WhatsApp JAIIB to the number 83609 44207, and I'll be sharing all the details with you. So thank you so much and see you again.